This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, so let's go through, have a look at depreciation. Hopefully it will all be pretty familiar to you. So remember, there are two types of depreciation that we follow. You've got your straight line. So remember, with your straight line, we charge equal amounts every single year, don't we? The only thing that I would just add in there is, remember, it's your cost less your residual value divided by your useful life. Okay, so make sure that if you are given a residual value in a question and it's a straight line depreciation, you deduct the residual value from the cost to work out the depreciable amount and then depreciate that depreciable amount over the useful life. Okay, so that should result in equal amounts of depreciation every single year. So what you usually see for for plant and equipment, land and buildings. Okay, reducing balance. Remember what you have there with your reducing balance. Nice and straightforward. You apply your percentage to the carrying value, don't we? Okay, so what you should end up with there is that you have higher depreciation in the earlier years where you're consuming more of the economic benefit and matching that to the expense that you are incurring, and then in subsequent years you get less depreciation as the carrying value begins to reduce more and more and more. So what you tend to see with motor vehicles. Okay, just bits and pieces. So from a financial reporting perspective, all that we've just mentioned really is financial accounting. From a financial reporting perspective, make sure that you depreciate it from when it is ready for its use. So if you're given two dates, when it's ready and when it is being used, depreciate it from when it is ready to be used, which is the earlier date. Okay, so you depreciate it from the earlier date, okay, when it is ready to be used. Okay, if you have any change in estimates, the policy is to depreciate. If you change the depreciation policy from straight line to reducing balance or vice versa, that's not a change in policy, it is a change in estimate. So as we'll see with IAS 8, any change in estimates are applied prospectively. So that means in this year and in future years. You don't go through and apply and change anything that has happened in the past. What's happened in the past stays in the past. Okay. However, what you then do is you take the new estimates, so the new method or the new life or the new residual value, and you apply that to the carrying value. Okay. So let's just go through. We'll leave the third bullet point for now. Let's just have a look at example number 3, this change in estimates. So again, it says calculate the amounts to be shown in the financial statements. So is that there for now? Statement of financial position, statement of profit or loss for the year ended the 31st of December 2015. Okay. It says Ecuador, very South American this chapter, isn't it? Ecuador bought an item of property, plant and equipment for 25 million years on the 1st of January 2012 and depreciated it over, is it the 10-year life? Okay, so originally we'd have been charging, is it 2.5 million every year? Okay, however, just note on the 31st of December 2014, the life was estimated as 5 years. Okay, so after 3 years of using the asset, 2012, 2013 and 2014, we then realized that the life had changed. So there would normally be 7 years left if we've used it for 3, but now they think there are only 5 years left. So therefore we need to change the depreciation. We need to change it prospectively, so in this period and in future periods, so we don't do anything about the old depreciation that has been charged. So what have we got? Well, again, we'll try to be consistent within our approach. We've got the statement of financial position. We've got the statement of profit or loss. I'm not worried about other comprehensive income. And then what we've got here is that we will have some PPE, and then we will also have some depreciation. And remember, the year, is it there, the 31st of December 2015. Okay, so let's look at our working. A little bit different from before when we had our evaluation. We're going to go through here and just have one column and work it down chronologically. Okay, so step by step. So what we can have here is the narrative, and then that one column. Okay, so we've got a change in an estimate, a change in the life, haven't we? So therefore we need to work out the carrying value at the date of change. That carrying value at the date of change, well, the date of change is December 2014. So if we start off with the original cost, the original cost was there on the 1st of the 1st 2012, which was there at 25 million. We need to get to the carrying value at the date of change, which is the 31st of December 2014, which to you and I is that 2 years into the asset's life. So what will be the accumulated depreciation? Well, it will have been the 25,000 over the 10 years. Oh, careful. Quick count on the fingers. 12, 13, 14. Okay, so that there is 3 years, isn't it? So 1 year is 2,500. 3 is at 7,500. So my carrying value at the date of change is 17,500. The depreciation, this is where we now look at the change in the estimate and apply it to the carrying value. So now that carrying value of 17,500 is adjudged to have a life of 5 years left. Okay. If we go through there, 17,500 divided by 5 is that 3,500. So that's my depreciation figure for the year. Okay. So 3,500 is my depreciation. So let's get that in whilst we can. And then what we also need to look at as well is the carrying value, isn't it? The carrying value is that 14,000. And that's the figure there, isn't it, on the statement of financial position at the end of the year. There we go. So 14,000 appears on our SFP. There we go. And again, if you so wish, we can reference those in, can't we, to our workings. Okay. Brilliant. There we go. Happy with that? That all okay? If you got any questions, please post them on the Ask the Tutor forum. It's where I check regularly and therefore make it much easier to reply to any queries. Okay, excellent. So we've looked at the cost, we've looked at the depreciation, we've looked at the revaluation. We need to pull that all together, don't we? Okay, so within the next video, we'll go through there and look at a larger example Are you confident in where you are so far? Yes. If that's the case, do the example yourself before looking at the video. If not, we'll work it through together, but it's entirely your choice. Okay, I want you to learn at your own pace. If you're not so comfortable with where we are, let's listen to what we have to say in the next video. If you are, have a go and see how you get on. Whatever you do, I'll see you shortly. Take care.